Right now, there is a stack of unclaimed money sitting with the IRS, with Social Security, and with Medicare that could be worth more than $16,000 a year to you. And most retirees never file the one form, check the one box, or make the one call that unlocks it. You worked for 40 years, you paid into the system every single paycheck, and now that it is finally your turn to collect, the rules have changed so many times in the last 18 months that even people who follow this closely are missing thousands of dollars every year. And real quick, this is general information, not personal tax or legal advice. Now here's benefit number one, because this one alone could be worth up to $6,000 off your tax bill this year. Let me tell you about a woman named Carol. Carol is 68 years old. She lives outside Columbus, Ohio, on a fixed income of Social Security and a small pension from 30 years as a school secretary. Last year, Carol paid her taxes the exact same way she always had. She used the standard deduction. She did not itemize. She figured, I do not have a mortgage anymore. I do not have big medical bills. There is nothing special for me to claim. Carol left over $1,100 on the table. Not because she did anything wrong, but because a brand new deduction passed into law in the middle of 2025, and her tax software did not walk her through it clearly, and nobody told her it existed. Multiply that by the number of retirees in this country who filed the exact same way Carol did, and you start to understand why the IRS is sitting on billions of dollars that belongs, by law, to people exactly like you. Here's the thing about being over 65 in America right now. The rules are not the same as they were even 2 years ago. Congress passed a massive new tax law in the summer of 2025. The Social Security Administration changed how it evaluates your Medicare premiums. The charitable giving rules from your IRA got more generous, and the income thresholds that decide how much you pay for Medicare got adjusted again for 2026. None of this arrives in a letter that says, hey, you qualify for more money now. You have to know to look for it. So where does all of this actually come from? It is not a rumor. It is not something I saw on social media. The bonus deduction I am about to walk you through comes directly from the One Big Beautiful Bill Act, the tax law signed in July of 2025, and from IRS guidance built around it. The Medicare numbers come from the Centers for Medicare and Medicaid Services. The Social Security numbers come straight from the Social Security Administration. The charitable IRA rules come from IRS Publication 590-B and Congress's own tax law summaries. Every single number I give you today, I want you to be able to go verify for yourself. That is the whole point. Let's start with the biggest one. Number one, the new senior bonus deduction. If you are 65 or older by the end of this year, the One Big Beautiful Bill Act gives you a brand new deduction of up to $6,000 if you are single, or $12,000 combined if you are married and both of you are 65 or older. Here is what makes this different from every other senior tax break you have heard of. You do not have to itemize to get it. It sits right on top of your regular standard deduction and on top of the extra amount you already get for being a senior. For a single retiree with modest income, that can mean going from an $11,000 advantage down to almost nothing owed at all, depending on your income. Now here's where it gets important. This deduction is not automatic in the sense that you do not have to think about it, but it does start phasing out once your income crosses $75,000 if you are single, or $150,000 if you are married filing jointly. It disappears completely above $175,000 for singles and $250,000 for couples. Most retirees fall well under those numbers, which means most retirees over 65 qualify for at least some portion of this. And here's the part they never tell you. This deduction is temporary. It is only guaranteed for tax years 2025 through 2028. If Congress does not renew it, it disappears. So this is not a someday thing. This is a make sure your tax preparer actually applies it this year and every year through 2028 thing. Number two, and this one gets confused with number one constantly. There is a completely separate older tax break called the Additional Standard Deduction for people 65 and up. If you are single, that is an extra $2,000 on your standard deduction. If you are married and both spouses are 65 or older, that is an extra $1,600 per spouse. Most people stop here and think that is the whole senior tax break. It is not. This older deduction and the brand new $6,000 bonus deduction stack on top of each other. They are two separate line items. A single 65-year-old filer can walk into tax season with a standard deduction, plus an extra $2,000 for being a senior, plus up to $6,000 more from the new bonus, all before a single dollar of income is even calculated. If your tax preparer or your software is only applying one of these, you are losing money every single year this deduction is in effect. Number 3. If you are 70 and a half or older, and you have money sitting in a traditional IRA, there is a strategy most retirees have never heard of that can quietly wipe out taxes on money you are going to withdraw anyway. It is called a Qualified Charitable Distribution, or QCD for short. Here is how it works. Instead of withdrawing money from your IRA, paying tax on it, and then writing a check to your church, your alma mater, or a cause you care about, you have your IRA custodian send the money directly to the charity. When it is done this way, that money is never counted as your taxable income at all. In 2026, you can do this with up to $111,000 per person, and that number goes up every year with inflation. Here is where it gets even more powerful. If you are 73 or older, and you are required to take a certain amount out of your IRA every year, whether you want to or not, that is called your required minimum distribution. A qualified charitable distribution can count toward that requirement. So if you already give to charity every year, you may be able to satisfy your entire required withdrawal and pay zero tax on it, simply by routing the money directly instead of taking it into your own bank account first. Most retirees are still writing checks from their checking account to their favorite charity and getting no extra tax benefit at all. That is real money left on the table every single year. Number 4. This next one could be worth over $2,000 a year, and it has nothing to do with your tax return at all. It is about your Medicare bill. There are federal programs called Medicare Savings Programs, and depending on your income, they can pay your Medicare Part B premium for you every single month. As of 2026, if your income is around $1,350 a month or less as an individual, or around $1,824 a month as a couple, you may qualify for a program that wipes out your Part B premium entirely, along with your deductibles and copays. If your income is a little higher than that, there are 2 more tiers of this same program that still cover your Part B premium alone, which by itself is worth over $2,400 a year. Here's the part nobody tells you. Millions of people who qualify for these programs have never applied because they assume Medicare help is only for people on full Medicaid. It is not. These are separate state-run programs, and the application takes about 20 minutes through your state Medicaid office. Number 5, and this one is connected to number 4. If you qualify for any of those Medicare savings programs, you are automatically enrolled in something called Extra Help, which slashes what you pay for prescription drugs. In 2026, Extra Help caps your copay at about $5 for generic medications and around $12 or $13 for brand-name drugs, no matter what the retail price of that medication actually is. For someone on multiple prescriptions every month, this alone can be worth thousands of dollars a year. And you can actually apply for Extra Help on its own, directly through the Social Security Administration, even if you are not sure you qualify for the Medicare Savings Program yet. Most people stop here and never even check, because they assume their income is too high. The income limits are more generous than most people expect, especially once you subtract the standard deductions the program allows. Number 6. Here's the part they never tell you about Medicare premiums. The amount you pay for Medicare Part B and Part D is not based on your income right now. It is based on your income from 2 years ago. So if you retired last year, or your spouse passed away, or you had one unusually high income year because you sold a house or cashed out a retirement account, Medicare may still be charging you a surcharge called IRMAA based on old, outdated income information. Here is the good news. The Social Security Administration allows you to appeal this using a specific form called SSA-44. And if you have had what they call a life-changing event, retirement, divorce, the death of a spouse, or a significant income drop, they can recalculate your premium using your current income instead of the old number. For 2026, that surcharge can add anywhere from about $80 to nearly $500 extra per month to your Medicare bill, for both you and your spouse if you are both on Medicare. Most retirees just pay whatever number shows up on the letter. Very few know they have 60 days to file that appeal and stop overpaying every single month going forward. Number 7. If you are thinking about selling the home you have lived in for years, there is a tax rule that could save your family literally hundreds of thousands of dollars. And it goes back decades, but most people still get it wrong. Under federal tax law, if the home has been your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of profit from capital gains tax if you are single, or $500,000 if you are married filing jointly. Here's an example. Say you bought your house decades ago for $80,000, and today it is worth $530,000. That is $450,000 in profit. If you are married, up to $500,000 of that is completely tax-free. Most people stop here, but don't, because here's the mistake that costs families the most money. If you gift that house to your adult child while you are alive, instead of letting them inherit it after you pass, your child inherits your original low-cost basis, not the current market value. That means when they eventually sell, they could owe capital gains tax on the entire increase in value since the day you bought the house decades ago. But if they inherit the home after your death instead, the tax code allows what is called a step-up in basis, meaning their cost basis resets to the home's value on the date of your death. In many cases, that turns a 6-figure tax bill into zero. This is exactly the kind of decision where talking to a tax professional before you transfer anything can save your family more money than almost anything else on this list. Number 8, and this is the one most people find the most surprising. The age at which you are required to start pulling money out of your traditional IRA and 401k, whether you need it or not, has moved. It used to be 70 and a half, then it moved to 72. Now, thanks to changes passed a few years ago, most people do not have to start taking required minimum distributions until age 73, and that age is scheduled to move again to 75 in the year 2033 for younger retirees. Here's where it gets important. If you do not need that money yet, letting it continue to grow tax-deferred for an extra year or more, instead of being forced to withdraw it, can meaningfully change how much tax you pay over your retirement. And if you do have to take a required withdrawal, but you are also charitably inclined, remember number 3, routing that required withdrawal directly to a charity through a qualified charitable distribution can satisfy the requirement without adding a single dollar to your taxable income. Most retirees are still operating off the old 70 and a half rule in their head, and either withdraw money a year or two earlier than they had to, or panic about a deadline that has actually moved. So here is what I want you to do with all of this, and I want you to do it this week, not someday. Go to SSA.gov and look up Form SSA-44. Even if you are not sure whether you have had a life-changing event, download it, read the list of qualifying events, and see if you match one. That single form can lower your Medicare premiums starting next month, not next year. While you are there, use the online screening tools to check whether you qualify for a Medicare savings program or extra help through your state Medicaid office. It takes about 20 minutes, and for many people it is worth thousands of dollars a year. That is the one concrete step. Everything else on this list, your tax preparer should be walking you through. But this is the one that most people never think to check on their own. If this video helped you see money you didn't know you were leaving on the table, that is exactly why this channel exists. To translate the fine print from the IRS, Social Security, and Medicare into plain English before tax season catches you off guard. Subscribe so you don't miss the next one, because next week I am breaking down exactly how the required minimum distribution rules interact with Social Security taxes, and it is a mistake I see retirees make constantly. Take care of yourself and take care of that money you earned.